Let's get some insights on the news that's shaping the markets. And for that, we welcome in Joe Brusuelas, chief economist at RSM. He joins me here at the desk at the New York Stock Exchange. Joe, good to see you. Thanks for joining us.
Well, thanks for having me.
So we're going to pivot, and we were talking about earnings. Now we're going to talk about the data. Of course, the jobs report, really the highlight of the day and the week. Before we get into the implications for the Fed, just kind of want to break down this data first. What was the key takeaway? Market seems to like it.
Well, there's a good reason why, is because the labor market growth is cooling from the torrid pace we've observed over the past number of months, in addition to the idea that, hey, look, we got a very solid economy, robust gains in productivity. We added 150,000 jobs this month. That's twice the number that we need to stabilize employment. All while inflation's easing, and this is, I think, the big takeaway, wages are now rising above inflation. As we head into the traditional holiday spending season in the fourth quarter, consumers are well positioned to continue spending, albeit at a more modest pace. Moreover, we just had that Fortnite story. It looks to me like if you got productivity expanding at a rate it is, your earnings are going to be okay. This isn't the story that we had just a couple of months ago. Things are looking much better.
What about the 3.9% unemployment rate? Put that into perspective for us, because it's the highest we've seen in quite some time. Does it still imply a strong but obviously cooling economy, or how should we be looking at that?
So right now, at our estimate of full employment is 4%. So we're actually still a little above probably where we need to be, but who's counting at that point? 3.94%. Look, demographics are going to ensure that we're going to have a low employment rate going forward for the foreseeable future. This is just not your father's labor market where we had excess supply. We're going to have insufficient labor supply for a long period of time, even with some gains in overall immigration, which I think is boosting both productivity and output. But for right now, I'll take that 3.9% unemployment rate. I'm just not worried about that.
And how much did the strikes that we've seen, whether it be UAW or healthcare or the entertainment strikes, how much did those play a part in these figures?
Great question. There were over 48,000 people on strike during the month of October. So if you're out on strike, you're not counted as employed, right? But there was an additional 33,000 people who were furloughed because of those strikes in the manufacturing sector alone. So actually, when we're looking at that 150, you're going to add those 33,000 workers back in next month. So the top line actually undershoots probably where employment is. Over the last 3 months, we've added 204,000. That looks about right to me. That's a nice, modest run rate.
Okay, so the big question, of course, is what does this all mean for Jay Powell and company? How much heat does this take off of the Fed?
This is real easy. Fed's done.
Okay.
Yeah, they're going to be on extended pause. I think early next year they're going to begin to pivot to begin focusing on stabilizing long-term real yields. Now, even though the Fed's not hiking rates, real yields can still increase, right? And that's one of the risks around the outlook. They're going to want to bring that back. And then at one point, my guess is sometime in the second quarter, begin cutting rates. But that's a 2024 story right now.
Right, but cutting rates, why? Because is it because inflation is back at target, or is it because this cooling but still pretty resilient economy actually starts to get a bit weaker and the Fed needs to?
It doesn't have to do with the things firms are trading on. It has more to do with corporate earnings and where they're going, and that has to do with the cost of doing business. So if you're out there and you're a mid-sized firm, you got to pay a SOFR rate, which is about 5.2. And our survey data implies there's a risk premium of about 800 basis points on top of that. So if you need to go out and get a commercial industrial loan, you're going to be paying between 10 and 15% based on the quality of your balance sheet. So that needs to come back if we want the economic expansion to continue. That's why the Fed's going to focus on real yields. Now, here's what's interesting, Caroline. Real yields right now, if you use the 10-year Treasury inflation protected security as the benchmark, sitting around 2.5%. Over the last 10 years, that's averaged about 0.25% or 25 basis points. In order for us to continue expanding, we need to see real rates come back down, probably to 1 to 1.5%. We're already hearing that from some of the Fed presidents, and I think that once we are certain that, okay, by the end of next year, inflation is going to be in that 2.5% range, they can then begin thinking about are easing what's very restrictive policy right now. And I think that's the key for next year.
But 2.5% is still above the Fed's target.
We're not going back to 2%.
So the Fed's target's just going to change, or they're just going to?
Well, over time. So what they'll do is in their next policy review, I think they'll change it, right? But if you look at inflation expectations, my preferred metrics, the 5-year forward, it floats around 2.5% to 3%. That's actually well anchored and fairly stable. You know, and the best of research implies that once inflation settles in somewhere between 3 and 4%, firms and households just get on with it. The Fed's going to get on with it too. And I think it's going to be one of the big narratives of next year.
Okay, I'm getting the wrap signal, so we have to make it quick. Are we avoiding the recession all out even next year?
We should quit talking about the false dichotomy of recession versus soft landing and just start talking about what's a very impressive business expansion.
All right, we'll leave it there. Joe, always a pleasure. Thanks so much. That was Joe Brusuelas of RSM.